Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. Happy New Year. This is Quincy Krosby. It is The Talking Point, and this is Tuesday, January 3rd. And the futures market, as I do this call, is all in green. It's just after 9 o'clock Eastern, and we see the futures up. Let's look at some of the reasons that the market could be up today. What is so special about today? Well, first of all, I do want to point out something. That yes, the Santa Claus rally, I'm so tired of talking about that. In the data books, in the data, right, it includes today and tomorrow, the first two trading sessions in January. And if we see a rally, obviously it will say that, guess what, Santa actually did not forget. Now, keep in mind that on Friday, what we had in the market was something interesting. The market was down, but it recovered quite a bit in the very end of the day. It didn't come in the green, but it recovered dramatically. And then the day before, we had an up market, and that was Thursday of last week. What was interesting about that recovery in the market on Thursday of last week, and I'm not here to, dredge up, what now is ancient history from last week, but it was very much cyclical. In other words, it was in tech, it was in the semiconductors, which I pay very close attention to because the chips are in everything. And we always pay attention to the semiconductor subsector as a bellwether of global demand in terms of manufacturing. And even, in just about autos and in refrigerators and, oh my goodness, even in toothbrushes. Heaven help me, I still brush my teeth in the old-fashioned way. But any case, the point is it really moved, and it moved quite steadily during the course of the day. This was last week on Thursday, and then Friday we saw the sell-off. We saw Tesla gain, we saw Apple gain, the heavyweights. But again, we saw profit taking on Friday, and then by the close of Friday, it had eased. In other words, the damage on Friday started to ease as we went into the close. So in any case, let's look at this week, and it's important because we begin the new trading sessions with the 10-year Treasury yield down. This is something that the market likes, obviously, even though it undoubtedly represents a growth scare, right? If you thought that growth was going to kick up dramatically and that we were going to have more inflation coming in, that 10-year Treasury would inch higher. Last week, it was moving more and more towards 3.9% on the 10-year Treasury. That was something that, the market did not want to see. And what we have today is, and remember, it didn't close above 3.9%. Remember on Friday, the Treasury market actually closed early in the day. It remained just under 3.9%. Today, we open, and it is about 3.7%. That's something that obviously the market wants to see, even though we can argue that what the Treasury market is seeing is a slowdown, an economic slowdown unfolding. Not necessarily a recession, but an economic slowdown unfolding. In any case, this week, we will have more information about the economy. But the other thing I do want to point out that today, and that is that something that I watch, again, very closely, is the Fed funds futures market. Yes, it is a market based in Chicago, market, the CME. And what we're seeing is that 25 basis points is being priced in terms of probability. It's over 70% probability for the Fed announcement on February 1st. Last week and the week before, it was about 64% probability of a 25 basis point rate hike. Now it is over 70% probability. and also for the March Fed meeting when we have an announcement. That's in mid-March. That, again, another 25 basis point rate hike. This is moving away from what the market had originally priced in, which was a 50 basis point rate hike for February 1st. Very interesting. But what it does is it matches up with what we are seeing in terms of inflation. That inflation is coming down at a faster clip, whether it is industry reports, whether it is anecdotal reports that we are seeing, inflation coming down at a faster clip. You know, we're also watching, for example, the pricing expectations coming in from manufacturers in the U.S. Pricing is coming down, and therefore, pricing power is actually easing. We're hearing from small business owners that hiring is getting easier. That's important because they have struggled. They've had to raise wages in order to not just attract workers, but to keep workers. Now they're saying that hiring is getting easier, and that obviously is important. So wage pressure beginning to ease a bit, and inflationary expectations coming down. That's the reason I think, obviously, that the Fed funds futures market is looking at 25 basis points as opposed to 50. Also, the Fed funds futures market is looking for and has been steadfast in its expectations that in the second half of 2023, we will have a rate cut, as opposed to the quote-unquote dot plot from the Federal Reserve's meeting saying, no, the Fed is going to stay on hold during 2023, and the first rate cut would come in 2024. Very interesting. Now, this could all change this week because we have really a busy week in terms of data. First of all, we are going to have tomorrow on Wednesday. Keep in mind, this gets so complicated, but I'm going to try to make it easy. There are two different measures of manufacturing from the purchasing managers. We watch what the purchasing managers have to say in the service sector and in manufacturing. They have a handle on what to expect. If anyone has worked, I even include this when I give, talks to your clients. I talk about folks who have worked in restaurants. You know that regardless of who it is, it could be the bartender, it could be the chef, it could be the owner of the establishment, knows what to order so that they don't run into problems with leftover inventory, especially if it's food, right? You don't want that. But they get an understanding of what to order. Those are the purchasing managers, and in larger companies, they play a very important role. Their job is to look ahead so that they don't build up inventories across the board. So again, this week we are going to hear from the purchasing managers. We will hear from them in terms of manufacturing and also in the service sector. There are two different firms or organizations coming out with the data. I have to say that I pay attention to the ISM, the Institute for Supply Management. I've been watching their data for many, many years, and it has, and this is why it's important, a very strong positive correlation with earnings. Yes, with earnings. And this is why early on, when we came through the pandemic, you would see reports suggesting pay attention to what the purchasing managers have to say, because it will be correlated with where the earnings go, how they flow. So in any event, what we're going to see this week is the service sector, and I do want to point out that the Institute for Supply Management, ISM, actually is still in positive territory in terms of what they see for the December. Remember, we're looking back, the December report for the service sector. The service sector has held up. You could argue it's because it has to do with holiday spending, and therefore, we had more activity. But remember this in terms of manufacturing and in terms of the service sector, which is obviously the largest part of our economy, is it not? It is 50 is the line of demarcation. And so below 50 is contraction, above 50 is still expansion. That said, we will look to see if it's coming down below where it was before. So right now, the estimates, consensus estimates for the ISM service sector is 55. Still in expansion territory, but we want to pay attention to whether or not it comes below 55 or above 55. In terms of manufacturing, we've already crossed the line of demarcation into contraction. But one of the things that we are seeing, and it's pretty steady, is that prices are coming down. And that is inflation, right? And that's why we're saying that inflation is coming down at a faster clip. Also, this week, we're going to have the FOMC minutes. That's the Fed meeting. You know, when we talk about the Fed meetings, we always say the Fed meetings. But what it is, it's a committee within the Federal Reserve. It's called the Federal Open Market Committee, the FOMC. Their minutes are coming out. This is the last Fed meeting. And it's important. We wanted to see, is there anything within those minutes that the market has not picked up? Because of so much Fed speak after the Fed meeting, because of the press conference after following the announcement of the rate hike, there's very little left to determine, is there anything new in those minutes? Years ago, the minutes would be extremely important because it would give you more color of what was the thinking behind the decision to keep rates on hold, to cut rates, or to raise rates. Now, again, we have so much talking. The Fed speakers out there nonstop. One of my colleagues made the comment, former colleagues, I should say, made the comment to me that it was so nice not to hear from any Fed speakers over the last number of trading sessions. Thursday, we're also going to have the ADP report. And that, remember, is private job openings. And consensus is actually that we would have about 180,000 new job openings. But again, this varies. The ADP changed its formula a number of months ago. Actually, right now, I would have to say many months ago. And we'll see how accurate it is. But keep in mind that on Friday, we get the all-important payroll report. That includes the government, and it obviously includes the private sector. So it's not 100% statistical correlation between the ADP and the government report that comes on Friday. But nonetheless, the trajectory actually sort of holds. If you're losing jobs in ADP, you know what? It may indicate that we're losing jobs in the government report. This week also we'll have motor vehicle sales, and you know we pay attention to that obviously. But we'll also have factory orders that will come on Thursday. So what are we expecting right now? What we're expecting is that we will hold 3.7% unemployment at the unemployment rate. That's consensus, right? We can move away from consensus. That's what consensus is right now. And also, and this would be good news for the market, and especially for the Fed, right? That is that wages will actually come down. The median expectations, consensus estimates happen to be right now that we will not see wages climb higher. In fact, they will inch lower. These would be average hourly wages. And that would be good news. And I go over this yet again, that when wages climb higher, what happens is it serves as an input cost, the same way electricity would be an input cost. And what the companies do, especially small business owners, is that they will try to pass that along in terms of higher prices. And so far, we, the end consumer, have been willing to pay it. What we're hearing from small business owners right now is that they are seeing that wages are coming down a bit. Question is, do they pass that along, right, as lower prices? That remains to be seen. So it's a very busy week for data. And what we will watch after that is, okay, what does the Fed funds futures market have to say? Do they then see inflation continuing to rise, and therefore that the Fed really needs a 50 basis point hike, and then the probability changes from 25 basis points back to 50 basis points for the February 1st announcement? We will see, right? Remember, the market is as data dependent as the Fed is. But overall, what the market seems to be waiting for are the earnings to come out. We'll start the earnings season in a couple of weeks. And the key here is margins. Are companies able to hold on to their margins? Because at the end of the day, that is really where the bottom line comes. Whether or not the margins pressure is just beginning to gain momentum. That's something the market does not want to see. So that, even though the earnings season is from the fourth quarter, right? We're looking back. The guidance is going to be important, and what they tell us about what their customers are saying, and also, what their clients are saying. This is what the market is paying very close attention to in 2023. Because, there's a tug of war in the market. One group saying that, we expect earnings to start really coming down dramatically, which would then mean the market has to adjust the valuation on the market, which right now stands at 17 times forward earnings. And that would just be too lofty if we're seeing earnings starting to come down and margin compression picking up. So this is something that's important as we go into the year. But that said, as far as the Fed is concerned, what they are focused on is, where is inflation? What's the trajectory? And what we see now is it's coming down. It's funny, when all of this started with inflation and we started to see, hey, this is not transitory, this is sticking. It was used car prices, if you remember, because the manufacturers were having trouble sourcing the semiconductor chips that are so important in manufacturing for the automobile industry. So this is something that we are watching very, very closely. We're watching to see what the companies say. P.S. Used car prices are coming down. But we're also seeing, very important, new leases, right? Because we're concerned about rents. The Fed is concerned about rents because they represent a large portion of the consumer price index, but more importantly, for the average person's budget. We're seeing the new leases coming down. And all of this is going to start showing up over the next couple of months in the CPI report and the PCI report, Personal Consumption Expenditures Index, the PCE, the Fed's preferred index. So a lot going on, but please have a very good start to the year. The data, just PS here, the data suggests when you have a bad year, it's typically followed by a good year. But there's always an asterisk, by the way, which says, not so fast. We will be watching the markets. We will be watching, above all else, earnings and also inflation, and what the Fed's reactions are going to be during the course of this year. Take very good care, and once again, Happy New Year 2022 over.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.